Hello, welcome to Business Incorporated live on Channels Television. Here's what's coming up in the next 55 minutes. International Monetary Fund approves $3.6 billion funding package for low-income countries. We'll analyze what indebted countries should be doing now as global debt levels is forecast to hit $100 trillion this year. Safe haven demand drives gold near all-time high above $2,700. And it's great to have you join us. I'm Ladi Williams. First off, let's get a check on what's happening with commodities, starting with gold. Now, we see gold hitting above $2,700 per ounce, a new high at this point, $2,729, 0.4%. Up. We're still seeing this rally continue regardless of geopolitics. So I guess that's why most of the investors are going for the safe haven asset. U.S. gold futures, $2,744, up 0.2%. We see gold hit all-time high of $2,740 yesterday. It's gained about 32% so far this year. The U.S. presidential election, just over 2 weeks away, with former President Donald Trump and Vice President Kamala Harris calling a knife-edge battle to win over some of the more competitive states. So we're seeing investors play into all of that sentiment. Let's look at other metals now. We see the likes of silver following up with that rally, 0.5%, up $33.93 per ounce. Platinum, $1,006, up 0.3%. So we're seeing all the metals here following this rally at this point. So at this point, it looks like just go in on any metal and you might make profit at this point. 0.6% for palladium, staying above that $1,000 psychological level. We'll keep our eyes on how these metals play out. But let's get a check on oil market now. We see Brent crude futures for December delivery. That was down about 19 cents, 0.3%, down $74 a barrel for Brent. Starting the week weak and continuing like that, even though we saw Monday had that jump, $70.43 for WTI crude, down about 18 cents. So we see the more active traded WTI futures for December, which will soon become the front month, that lost about 14 cents to $69.90 per barrel. So geopolitics going the wrong way for oil at this point, because we know how that impacts oil prices. Any supply issues usually jacks up the price, but now it's all about demand. What's China going to demand? And that's what we're seeing weakness there for the oil market. For earlier now to other stories, we see the movement of fuel in Nigeria has become a source of concern for many with the recent tanker explosion in Jigawa State. According to Group Managing Director of Rain Oil Limited, Dr. Gabriel Ogbeche, this can be avoided by using our pipelines. He made the comments earlier with me on Business Morning. Take a listen.
Nigeria is consuming 45 million liters of petrol every day. If you break that down into every single truck of 45,000 liters, that's 1,000 trucks being put on the road every day. Now, without our inland depots working, what that means is that every day, a good chunk of these 1,000 trucks are moving from the coast into the hinterland. Every single liter of petrol that is consumed in Abuja, every single liter of petrol that is consumed in Kaduna, every single liter of petrol that is consumed in country has to travel across the country just to go and deliver. It is not efficient. One good way of de-risking it is make these inland depots to work. They've been there. I've been in this industry now 32 years and counting. And I met all these depots, I met all these pipelines in the downstream. They've always been there. But today, a lot of them, if not practically all of them, they are moribund. They are there. They are idle. And the pipelines are there. So we need to reactivate them such that if you need product, if the person in Jigawa, for example, needs product, he doesn't need to go beyond the NNPC depot in Hotoro in Kano to go and get product. You don't have to move the product all the way from Lagos to Kano.
And to other matters now that relate to compliance and regulation as the adoption of virtual assets grow in Nigeria. The Securities and Exchange Commission, in conjunction with the Nigerian Capital Market Institute, is ramping up awareness for regulatory compliance. At an event held in Lagos, stakeholders discussed the way forward in the ever-evolving world of cryptocurrencies and adherence to Financial Action Task Force rules. The Nigerian Capital Market Institute, a branch of the Securities and Exchange Commission, organized a compliance summit aimed at chief executive officers and compliance officers, and the focus is the Financial Action Task Force and other pertinent topics.
To align with FATF standards, the following strategies must be considered: a risk-based approach, compliance programs, implementation, and indeed international cooperation as we'll find necessary. We are ready to cooperate, we are ready to collaborate, we are ready to listen to your feedback, we are ready to change when we are wrong, and we are ready to move this market forward.
Also on the front burner is clarity on the latest updates to FATF standards and how these impact virtual asset service providers.
As the regulator, we have a twin mandate to regulate and to develop. So all we can do is to facilitate and engage. And that is why we are here today. So collaboration is very key. I'm calling on everyone here present to really do roll up their sleeves and let us think of how we can raise the level of compliance in this market.
As Nigeria moves to license virtual asset providers, stakeholders in Nigeria's blockchain industry call for clear rules as virtual assets are included into Nigeria's capital market.
The issuance of license has brought us into the capital market, but I don't want to feign ignorance that, oh, I understand the capital market and how it's pro. I'm a technology person. I understand the technology. I don't know how you move money in the capital market because some of you have been there 20 years, 25 years. You know, maybe at that time I was in secondary school when you started out in the capital market, but I am here now. I'm a part of you. I want to be involved in what you are doing, and I want to understand how it's done and to do it properly. Because I have something that is actually bigger than what you are currently using, that if you get plugged into, it can accelerate what you are doing as the capital market.
With the growing adoption of virtual assets in Nigeria, the Securities and Exchange Commission understands the need to rethink regulatory strategies to ensure protection of Nigeria's capital market. Remember earlier in the morning, I mentioned that John McCoy is in Washington, D.C. as the World Bank IMF annual meetings enter Gear 2. But let's hear from Ini now. Ini joins us all the way from Washington, D.C. Great to have you, Ini.
Hi, Laddie. Good morning. Good to be here.
Fantastic. And I'm sure the weather is not so bad there.
Yeah, well, it's not as warm as home, but it's fair, at least for now. I think it's get colder after this time, then you don't want to be here. But I mean, at this time, it's still walkable. I think I'll put it that way.
Fantastic. But we're already missing you back here, and we'll have you back soon. But yeah, bring us up to speed. What's been playing out there? I know all the central bankers and finance ministers are there, and they're firing on.
Yes, they are, Laddie, they are. So major meetings starts today, the second day. Of course, they've been preliminary meetings from the first day. That was on Monday and all of that. But Laddie, I think what we would remember this year's annual meetings for would be that the two Bretton Woods institutions are turning 80. That's 8 decades of operations. And then that the world is changing. The face of the economy is changing. So our nations are no longer friends because you have what I need, or I have what you need. The geopolitical tension in the world is reshaping the world. They say it's reglobalization, taking a different trend. So even though one nation used to be friends with the other and they used to cooperate trade and services, sentiments are now beginning to set in, and this is a huge challenge for IMF and the World Bank because they seek a world that collaborates and cooperates for trade, for services, for poverty reduction, and all of that. And this actually makes it even more difficult than it was. So yes, we're dealing with poverty. And I did hear you talk about the issue of global debt, which the IMF said is going to be about almost 94% by the end of this year of GDPs. And it's a global problem. It's not just the low-income countries' problem. It's everybody's problem. So that is on the one side. On the other side is how the IMF and the World Bank can stay neutral in the midst of the sentiments that are flying everywhere. And that's why there's the issue of financial fairness and all of that. Can they be able to stay above the sentiments of the different countries and respond according to their talks about changing quotas, as members of IMF and World Bank, in their aid and all of that. So these are very important issues that will be discussed at this meeting as they celebrate 80 years and as the world meets. And Sub-Saharan Africa is going to be in the news today. There's the issue of electrification, renewables. We know there's no economic development without electricity, and this has been a major talk. So that and a whole lot more, Ladi, is what is on the front burner here at Washington as the world meets at the annual meetings of IMF and World Bank.
Fantastic. Well, thank you so much, Ini. I know we're going to get more information as it plays out right there. Thank you so much, and great reporting as usual.
Thank you so much, Ladi.
Yeah, and according to the International Monetary Fund, global public debt is expected to remain high, surpassing $100 trillion in 2024. As Ini said, about 93% of global GDP. So what should countries struggling with high debt levels right now be doing, especially in Africa? Join us for this conversation. We have Mr. Yitayo Ende, a Chief Operating Officer, KI Limited Financial Advisory and Investment Company, joining me right here in the studio. It's great to have you.
Thank you. Thank you for having me.
So I'm sure you heard our correspondent right there in Washington, and on the front burner is this global debt issue and how the IMF and the World Bank can be fair to every country, at this point. And I know the IMF, they have a mandate of maintaining exchange rate with member countries. But we're seeing, a member country like Nigeria now, we've seen our currency devalued by over 100%, depending on where you're, looking at the devaluation from. So, talk to me about this debt, this forecasted debt level for the global market, and how is this something we should be afraid of at this point?
All right. Thank you, Lady, for having me. I think well projected by the IMF, right? Given that we expect more spending in globally in healthcare, right? In healthcare, in social amenities, in other infrastructure, infrastructure in key sectors of the economy, the IMF has rightly projected, right, that public debts will increase by about 115% of the current position. Now, global GDP, right, is about $110 trillion. Now, so the expectation of IMF, in line with the projection, is that in the next 3 years, thereabout, over the course of 3 years, we should be looking at a public debt, a public debt of about $126 trillion, globally, which, in line with their projection also and their assumptions, I think is pretty in line. Why? Because we should expect, as I said, more funding in healthcare, in social amenities, in critical sectors of the economy. Let's also not forget about the issue of the AI. AI will, require a lot of capital, right? America is already talking about it, about injecting capital into AI, So, those are issues that we, bring about incremental public debt of many countries.
But if we look at, the global space at this point, let's look at global development.
Okay.
Let's merge that with global debt.
Yes.
Would you say the development we've seen globally, matches the kind of debt we're seeing on the global scene?
Yes, I will say there's still room. There's still room for improvement. I was trying to explain, that why the public debt will also increase in line with the projection of IMF is that, for many countries, the defense spending is also increasing. We understand what is going on, the political instability, the wars that are raging in almost everywhere, in Eastern Europe. We knew what happened with the unprovoked invasion of Ukraine by Russia, right? And so many other countries around that corridor, the Eastern European corridor, are, also because of the raging tension, from Russia, against some of its, the neighbors in that corridor, the likes of Denmark, the likes of Georgia, Poland, and the like. They are, in the process of also increasing their defense spending. As a matter of fact, Poland.
So I guess the world is spending so much in defending itself.
In defending itself against an aggressor,
right.
Which, a lot of experts have defined Russia to be. You understand? So we expect that, not also forgetting that, the wars in the Middle East, so you expect, Lebanon, Israel, and even Iran to also increase their defense spending relative to their GDP. The likes of Poland, they are projecting to spend about 4.12% of GDP on defense. We also come down to sub-Saharan Africa, in the Sahel Africa, in the Horn of Africa. We also know what is going on, the war that has been raging between Somalia and Ethiopia. All of these will consummate in increasing the public debt. You understand? And I believe that, it is not for the global powers, For example, look at the biggest economy in the world, America, with an economy of $35 trillion, right? Sorry, with an economy of about $29 trillion, they have a debt portfolio of about $35 trillion. That is about 121%. What that means is that America has borrowed 121% of the economy, but they are managing this debt stock effectively. How do I mean? The appropriation of America that just lapsed last month was $6.72 trillion. That means they spent $6.72 trillion, right? Out of it, 73% of that were revenues that were raked in. Their debt servicing was below 20%, about 16%. America is paying about
that's quite a healthy debt.
Beautiful. They are paying about 1.13 trillion on debt servicing. So they are able to manage it effectively. This is not the same picture that we see in sub-Saharan Africa. For example,
let's bring it down to Nigeria.
Exactly.
At this point, we see our debt stock that hit over 100 trillion naira.
Yes.
In the previous data, and definitely we're not spending against trying to defend against an aggressor.
Yes.
At this time, even though we know there's an insecurity, problem.
Yes.
So what are we really spending on?
The issue with Nigeria, actually, at the moment, our debt to GDP is slightly over 50%, right? What that means is that we have borrowed 50% of our economy. At the moment, we have an economy of $252 billion, right? So, in essence, is that debt too much? No. Relative to our economy, no. But the issue with Nigeria is the revenue generation. We're having pretty difficulty in generating revenue. Now, how do I mean? A communique was just issued by DMO, the Debt Management Office, right, a few days ago, to say that over the course of 6 months, the first half of the year, that debt servicing skyrocketed by 69% to 6.04 trillion naira. And we were only able to rake in 3.7 trillion naira in revenue, right? And Debt Management Office also, from their press release, said that 162% of our revenue was used to service our debt. That is unsustainable. It's a recipe for disaster. What that means is that not only have we completely utilized our revenue to service our debt, we have borrowed 62% of the revenue of 3.73 trillion naira to service our debt. You cannot be using your revenue to service your debt. Mind you, I said for America, in spite of their humongous debt portfolio of $35 trillion, right? Their debt servicing is below 20%. It's about 17%, right? But in Nigeria, our debt servicing, from what DMO just released, is that the first half of the year, we have spent 162% of our revenue to service our debt.
But now we see the battle to tame inflation. We see the central bank trying to mop up as much liquidity at this point. We've heard some experts say the major problem is money supply. In Nigeria right now. So, what do you think is the short-term way forward, for this government to say, you know what, even though we're trying to tame inflation, we're trying to mop up excess liquidity, we still have to manage our debt at this point. What should be the plan of action at this point?
At the moment, the government has decided to overwhelmingly, adopt the liberal capitalist economic ideology of free market economy, where the prices of goods and services, especially in the forex market now, relative to the forex market, the price of the currency, Nigerian currency, is determined by an interplay of demand and supply, So they've allowed the market to determine the price, And that is why we are where we are in terms of the level of devaluation that we have experiencing. We have never seen anything like this before, But you see, it's a beautiful initiative, a beautiful economic policy of the government, even though a plethora of experts, economic experts, have argued against it, that a cautious or controlled, free market, economy would have been better, it would have been more economically beneficial to the nation, instead of just, adopting, 100% liberalizing the market. But having said that, the government is doing everything possible to also rein in the inflation. And we must also give kudos, to this present administration. One of the key policies, economic policies that this government was able to do, was when the Federal Executive Council and the President, Excellency Bola Ahmed Tinubu, authorized Nigerian National Petroleum Corporation Limited to naira sell the crude oil to Dangote and other local refineries. That was a bold move, and it was historic. Why? Because it moves away from what we used to, the norm, where sales of crude oil were consummated in foreign currency. Because when you do that, you put pressure on the dollar, And unfortunately, we are an import-dependent country.
And we need less pressure on the naira.
Exactly.
At this point. Even though we're seeing the government, making moves like selling oil in naira, at the same time, we also need to see other spending too from this same government. It should also be in naira as much as possible, and not, we still do a lot of foreign goods, even when you look at some of the procurements, from this government. So we need to see that all round.
Absolutely. You see, we no doubt Nigeria we're having a hard time economically, and Nigerians, even though very tolerant, full of grace, are crumbling under the weight of these economic problems in this country. The affordability crisis, the regressive, raging, inflation tax that is biting bitterly, almost everybody in Nigeria, especially the middle income earners and the poor, and those men and women,
class have been wiped out at this point.
Those men and women that are living from paycheck to paycheck. Disposable income is at its lowest ebb. Purchasing power has dropped significantly. But you see, again, what I believe the government needs to do, because you see, you rein in inflation in two ways. It's either you mop up excess liquidity or you increase domestic production, And that is what I believe the government is trying to do in the petroleum space. By authorizing, NNPC to naira sell crude oil to Dangote, So that they can stimulate local production in the petroleum space, So that, and some time ago, the vice president was credited to have said that about $25 billion, is being used yearly for petroleum product import, And if you also check from the data available, from data available, that the Nigerian import bill for 2023 was slightly over $45 billion. What that means is that for only petroleum products alone accounted for about 55% of our total import bill in this country. That is huge. That's concentration risk, And we cannot continue to spend so much on just one product line, That is what is putting pressure on the economy. And the president has done brilliantly well in this regard, To say, no, instead of us to begin to import, let's stimulate local production. Because when you stimulate domestic production, you can bring down the cost of goods, Just like I said, you rein in inflation either by mopping up excess liquidity, or you increase production. And that is what the government is doing right now.
Okay.
But I hope the initiative will be...
I hope it cuts across.
Exactly.
At this point.
Exactly.
And we can reduce most of these price pressures.
Exactly.
But it's so much to unpack there, but it's great having you. We've run out of time. Thank you so much, Mr. Itayo, and the Chief Operating Officer, KI Limited, as a financial advisory and investment company. Thank you so much for coming.
Thank you. Thank you for having me.
All right, we'll take a break now. When we come back, we'll head straight to the markets. That's in a moment. Just stay with us. All right, welcome back. Let's get a check on what's happening with the markets. Let's start with Africa now. We see the NGX there kicking off intraday in negative territory, but it's quite mixed on the African continent with most of the markets that we track. We see the NGX up was lower before now, but I guess we've seen a flip move there, 0.64% for the NGX. The all-share index intraday, 0.48%. That's what we have for South Africa. And other markets we track in Africa. If we look at Kenya, we see Kenya and South Africa there. We see not looking so bad. Egypt, EGX 30, 0.02%, marginally down. Then Kenya, the trading on Monday ended positive 1.09%. So we're seeing a convincing 114 points for the all-share index, staying above the 100 level. That's for the all-share index in the Nairobi Stock Exchange. But let's bring in James Adisa now to bring us up to speed with what's happening on the NGX. Hello, James. Hello, James. Yeah, fantastic. Great to have you. So we're seeing, I don't know if it's still positive sentiment. What are you seeing right now, the NGX trading?
So we're seeing that the market is about 4 basis points up. Primarily, we're seeing some interest in the banking names, FBNH, GTCO. Also seeing some interest in Wando that's driving the market up. Generally, sentiments are positive, but the market has been relatively quiet. There was a cross of around 2 million in Seplat. Saw it close. Saw the price drops about 5.7, but it's trading up now, going to about 6.2. So generally, the market has been positive. We expect this sentiment to continue as we continue to see strong financial results, as we continue to see corporate actions for some of these listed companies, that we expect to drive the positive sentiment moving forward.
Right, and it's definitely earnings season, and we expect to see more earnings from most of these companies. We saw the impact of UBA's earnings yesterday on that stock. But let's talk about the new kid on the block there on the NGX. That's Ardo Holdings. After listing on the NGX, what do you think is happening with the stock? Is it profit-taking?
Yeah, we're seeing some profit taking in RDL. Some of the investors who were already in the name prior to the listing on NGX are beginning to take some of their profits. But fundamentally, the business is really strong. There was also some news flows around the name that sort of translated to soft investors' interest in the name. And that has also contributed to the losses that we've seen in the name so far. But generally, I think fundamentally the business is strong. As a long-term investment, it's definitely one that investors should look at.
All right, definitely. We'll keep tracking to see how it plays out. Thank you so much, James Adisa, financial analyst, Chapel Hill Denham. Thank you.
Thank you for having me.
All right, now let's get a check on what's happening with U.S. markets. Now we see there was lower for the overnight trading. If you look at the U.S. markets with the Dow Jones Industrial Average, it snapped a 3-day winning streak. Futures stocks to the Dow edged down by 99 points, so it's 0.24%. Mostly the same range at this point, down. Tech-heavy NASDAQ, 20,459 points, down 0.28%. Let's take it on to Asia now. We see Asia-Pacific markets. We see a lot of stocks there slipping, trailing mix. The mix section we see in the U.S. Nikkei 1.39% up to close. Hang Seng Index 0.02% up, but the Kospi there is big, down by 1.31%. Other markets we track in Asia now, I will see in India, that's the Nifty 50, down by 0.80%. And the Shanghai Composite, 3,285 points, 0.54%. So that's a picture right there in Asia. All right, let's get a sense of what's happening in the UK. Definitely, we have Juliana joining us from our London studio. Great to have you, Juliana.
Good afternoon, Laddie.
Fantastic. So definitely, we've seen much more data coming out from the UK. Talk to me about the latest data out this morning.
Yeah, that's absolutely right. All roads are leading to the budget, a really symbolic budget, which is going to be announced next week by the UK's first female Chancellor of the Exchequer, Rachel Reeves. Of course, this is the first time we're going to see the economic policies by the Labour government. And since their historic victory a couple of months ago, there have been some fears that perhaps all isn't as it was claimed during the campaign, as we're typically used to. And there has been more headache this morning for Sir Keir Starmer, the Prime Minister, and Chancellor Reeves. And that's because the Office for National Statistics have released borrowing figures for Britain for the month of September. And it's actually the highest, the third highest September borrowing figures on record since records began in 1993. And it's come in at over £16 billion. Now, is this going to change the text and the content of next week's budget? I don't think so, but it does show the kind of economic woes that we have in this country. Now, when it comes to borrowing, one of the reasons why the figure was so high in the month of September is about public sector pay. Now, you'll remember, because we discussed it extensively for over a year on your show, Laddie, that there were a series of strikes, not just in the private sector, but in the public sector. And both the Conservative government under Rishi Sunak and now the Labour government under Sir Keir Starmer gave in to the striking workers and lifted up the pay. Now, I think what has been reflected in September's data is the significant pay rise that junior doctors managed to strike with the Labour government in July. So that's really beefed it up. And I think it's worth pointing out for some of our viewers that the borrowing is basically the difference between debt and your tax income. So it is significantly high. And in fact, I think the UK's debt is currently at about 98.5% to GDP. A lot of people don't talk about that. We talk about lots of debt in African countries. The West are in significant amount of debt. In fact, that's one of the major talking points in Washington, D.C. This week. So more headache for the British government, the Labour government, the Office for Budget Responsibility. I think they put in that debt was going to be about £15.1 billion. It's so much higher than that. So also as well, lots of discussions in the UK about forecasting and whether or not there needs to be some sort of change in the way these independent as well as government-supported agencies are forecasting, because they do appear to be getting it wrong so often these days. Right.
Well, I guess as long as your debt servicing is not so high, then maybe your debt might still be healthy at this point. But we see that's Goldman Sachs. They're predicting that UK interest rates will fall to about 2.75%. I guess it's all within the rate cutting cycle we're all expecting here.
Yeah, that's absolutely right. Some pretty optimistic outlooks from Goldman Sachs. They believe that interest rates in the UK, as you quite rightly said, will dip to about 2.75% early 2025. Completely in stark contrast to what we've heard from other analysts who are suggesting that perhaps by this time next year, interest rates in the UK may fall to about 3.75%. And the reason why they forecast this is inflation, really. Last week, Office for National Statistics revealed that inflation in the UK had dipped to 1.7%. That is the lowest we've seen for years. It's well lower than the 2% benchmark that the Bank of England have put in place, and significantly lower than the double digits where we were. And of course, we know that when interest rates are high, it does have a knock-on effect. It costs more to borrow. There is a certain sector of British society that are kind of carrying the burden for the rest of the nation, namely mortgage holders who have been paying ridiculously high monthly mortgage rates. And of course, we know that if interest rates are high, people are less less likely to spend. Businesses are less likely to invest. So it is in, the good of the country for interest rates to fall. But of course, we've got to be cautious. I think Andrew Bailey, the central bank governor, has said that he wants to take his time. He doesn't want to be too aggressive with rate cutting because, of course, we know as soon as they are cut, people do spend more. The demand increases, prices go up. So it's a delicate balancing act. But again, I think the Labour Party, Sir Keir Starmer, they're really looking for some economic light at the end of the tunnel. So perhaps if the Goldman Sachs forecast is right, we can start seeing the economic growth that we saw pre-COVID in this country.
Yeah, definitely quite interesting. You don't want to cut too fast and you don't want to cut too slow. Delicate balancing act there. But how are the markets looking in the UK?
Down. Red is the colour of the markets in the City of London at intraday, Laddie. The all-share is down at intraday by 0.47%. The FTSE 100, the blue chip, down 2 by 0.59%. In the FTSE 250, the domestic market, that's also down at 0.40%. That's all about that borrowing figures we just discussed. In the currencies market, the British pound is currently trading up against the US dollar by 0.04%, though down against the euro by 0.06%, but up against the Japanese yen by 0.21% at intraday, Laddie.
All right, thank you so much, Juliana, for giving us the details right there from the UK. Let's take it on to Europe now. We see Russia is hosting this year's summit of BRICS countries, as despite Western sanctions over the Kremlin's war in Ukraine. Join us to look at how the EU is looking at the summit. You have DW correspondent Chimpona Jimbelu. Great to have you, Chip. So why is there a growing concern about the BRICS group of countries in the EU?
Thanks for having me. Well, Laddie, there is concern in the EU because the BRICS countries and the bloc have divergent approaches when it comes to the conflicts in Ukraine and the Middle East. And that has meant differences on UN resolutions and challenges getting sanctions imposed successfully. For instance, despite the fact that Russia is the world's most sanctioned country, it has still managed to raise money for its war chest. Now, that's because Western countries have been unable to get many other countries on board when it comes to isolating Russia. And the BRICS group is growing. At the beginning of the year, it admitted 4 new members: Egypt, Ethiopia, Iran, and the United Arab Emirates. And according to some estimates, the BRICS Plus now accounts for more than a third of global GDP. That is more than double the EU's.
All right, so we know Putin is hosting this year's summit. Is he trying to send a signal here?
Well, for Russia's President Putin, this summit is really about showing the world that his country isn't isolated. The Kremlin has had to turn to other partners to make up for what it has lost amid Western sanctions. Trade with the BRICS group has been increasing. India, for instance, accounted for more than a third of Russian crude oil exports last year. And last July, it surpassed China to become Russia's top oil buyer. Now, that's because Russia has had to seek new buyers for its new energy exports, and it has been selling crude at a discount because of the G7 oil price cap. Meanwhile, refined oil imports from India to the EU grew to record levels last year. That means that European consumers have most likely been buying Russian oil products via India, despite the sanctions, and they have not been purchasing them at a discount. And the BRICS expansion may be on the horizon. Reports citing Russian sources say that another 30 countries may be interested in joining the group, including Turkey and Saudi Arabia. However, analysts expect no new member countries to be announced at the summit this week.
All right, we'll definitely be listening for that. But what can we expect from the markets in Europe?
Well, Laddie, markets are facing a bumpy ride in the final stretch to the U.S. presidential elections. Recent polls appear to show Democratic nominee Vice President Kamala Harris trailing Republican nominee former President Donald Trump. And European policymakers in particular are concerned that Trump will start a new trade war, and that would, of course, hurt European exporters. Now, today, European trading is most likely to be subdued after a broad sell-off on Monday. And investors would turn their focus to the IMF annual meeting later. The International Monetary Fund is due to update its world economy outlook.
All right, Chip, thank you so much for the details there right in Europe. All right, to other stories now. The Nigerian Doctors Forum in South Africa, in collaboration with Nigerian and South African nurses, highlighting the significant disparities between public and private healthcare. Public facilities are often overcrowded, resulting in long wait times and inadequate patient care. Our South Africa correspondent Innocent Simosa reports.
In an effort to address the pressing healthcare disparities in South Africa, the Nigerian Doctors Forum, in collaboration with Nigerian and South African nurses, recently organized a medical outreach in Johannesburg.
It's an annual program, but apart from the annual program, we still go to different locations. We go to different locations in South Africa here. We go to different provinces. We also engage with different associations in South Africa.
Now in its 12th year, the president of the Nigerian Doctors Forum, South Africa, Dr. Ugu Emeka, says the journey has not been without challenges.
Challenges we have, of course, we are foreigners. We remain foreigners in South Africa, and the issue of foreign nationals vis-a-vis the locals, which we're trying to push so that we integrate ourselves the much we can. In all honesty, we've tried to do this at Maponya Mall, the biggest mall in Soweto, if not in Johannesburg. We wanted to go there and give free medical services to as many South Africans, as many other nationals that are there, but we are restricted because of, laws.
Channels Television spoke to several individuals who received assistance during the outreach.
So this outreach is always very profitable to a lot of both Nigerians and anyone who needs medical attention, because trying to get medication here in South Africa is a bit difficult for some people who can afford, because the economy has been a bit difficult lately.
And coming to the terms in their initiative, I would say is a very good one, because a lot of us here, we all know how expensive to go to private doctors are these days. So this type of initiative is a very good one.
Even locals received medical attention. Their stories highlight the critical need for initiatives like this.
I feel so happy. People here, they were so helpful. I came feeling some pains and I explained to them, and they gave me all the medications for the complaints that I had.
We look forward to seeing more initiatives that promote health equity, not only in South Africa, but on the continent as a whole. From Johannesburg, South Africa, Innocent Simosa, Channels Television News.
All right, thanks for that, Innocent. Let's look at some commodities now. We see eggs are a staple in household diets globally, providing an affordable and accessible source of high-quality protein. But in Nigeria, we've seen the price of eggs surge by 100% over the past year, rising from 3,000 naira to 6,000 naira per crate, far outpacing the food inflation rate about 37.77% in September. Joining us now is Tomiwa Ajewole, is an analyst, financial directors company. Great to have you, Tomiwa. So what key factors are driving this sharp increase in the cost of what should be a cheap source of protein?
Yeah, thank you for having me, Ladi. With the factors, I don't even know where to start, because the business environment for poultry farmers currently is not favorable. And what we're seeing now is just a rise in the cost of production, and farmers having no choice but to just pass that burden on to consumers. Because, when it comes to egg production, feed mill, which is for the hens that lay the egg, makes up about 70% of the total cost. And right now we're seeing the raw materials of this feed mill, which are mainly agricultural products, by the way, like maize and soya bean. We're seeing their prices skyrocket. Maize is currently going for about 700,000 to 800,000 naira per ton, which is up 50% from last year. And soya bean is almost 900,000 naira per ton now, when last year was 450,000 naira per ton. So, we're seeing all this increase in price. Nigeria's agricultural output is low. There's insecurity in most of the areas where we farm. And of course, the weather the environment is also not favorable for planting. So we're seeing this rise in all these input costs. And even if we want to look at importing these raw materials, the naira is now back on the slide, currently trading for about 1,725 naira per dollar. from about 1,600 naira per dollar about 2 months ago. So that again just discourages importation to break down the price. So farmers with this facing this cost of production to protect their own profit margin, they have no choice but to just pass on this price, this increase, to the consumers. And just even if we look away from raw material, just petrol or price of petrol just went up, recently. That increases cost of operation, that increases logistic and transportation costs, and those are the factors that farmers are just dealing with, the poultry farmers are just dealing with. So having no choice but to just pass on to to keep them, to increase the incentives to continue to produce, they'll have to pass this burden on to consumers,
right,
as well those have eggs in the country. And
I'm sure at some point consumers would, even though they get passed on most of this cost, they'll just pass it back, somehow, tired of rising prices. But talk to me about what you think is the way forward at this point. How we know at the end of the day, everything just seems to point towards the dollar, and the naira. What do you think the government can do short term?
Yeah, we're going to focus on one of the key factors, which is the feed mill and the inputs. There's nothing new under the sun, and the smart thing to do is always to learn from history, to learn from others who have faced it. And India currently is the third largest producer of egg globally, and in 2020 they faced exactly what Nigeria is facing now. Our price of egg was going up, was increasing, and because input cost was increasing. 2020 was the COVID year, and there were supply chain disruptions that led to the increase in the price of inputs. But what India did was that their government stepped up. They subsidized feed mill, and they also facilitated distribution of other alternatives of feed mills, such as rice bran and broken rice, and also they put a ceiling on the price of eggs. So one thing that Nigeria can do, obviously, we have to look to the government. The government has to step up. They remove subsidies on petrol. We have extra revenue. We need to start subsidizing production. Feed mills can be subsidized. We need other alternatives to the feed mill, and also again, apart from feed mill, just generally improving the business environment in the country. The government they brought in this initiative of the import duty waiver, but with the naira depreciating, that negates the gain from the import duty waiver. So of course the naira is a key issue. There has to be long-term strategies to actually improve the naira, not just short-term strategies, long-term strategies like increasing oil production and things like that. But apart from that, going back to the agriculture and poultry farming, even there itself, we need to improve our efficiency in that sector.
All right, Tomiwa, thank you so much. I guess at this point, save the naira, save us all. Thank you for your input there.
Thank you for having me.
All right, so we see the IMF have confirmed that the executive board have approved some reforms on a funding package of 2.7 billion SDR for low-income countries. The multilateral organization said the reforms were on its concessional lending facilities and associated funding strategy to preserve its ability to provide adequate support to low-income countries over the long term. All right, let's get a check of what's happening with Bitcoin now. We see definitely some red on the screen at this point. We've seen pullbacks from Bitcoin after touching that 69,000 level. Then we can see some headlines. The ECB's Bitcoin paper. We've seen some comments trailing that paper there. Some saying that it's going to put a lot of pressure on innovation at this point. That's for the ECB, European Central Bank, for that paper. All eyes right now on regulation. That's for the cryptocurrency market. Then we see the BRICS cryptocurrency adoption. We see Putin there advising BRIC countries to adopt cryptocurrency to reduce reliance on the US dollar. We'll see how that plays out. But joining us now is Adebayo Adebajo, his co-founder, ICP.hub, Sub-Saharan Africa. Great to have you on the show.
Great to be here once again, Larry. Thank you for having me.
Right. So how are you seeing Putin's strategy here? He's saying most of these member countries should adopt cryptocurrency to reduce reliance on the dollar. Do you think it's going to work?
Yeah, absolutely. I believe it is going to work, because if you look at the recent trend in the Bitcoin, or even in the general cryptocurrency ecosystem, there's been a lot of adoption, courtesy of the ETFs and the majority of other institutional, people coming into the industry. So the fact that Putin is making it known publicly as a government that they are supporting Bitcoin as a major means of transaction is nothing new anymore in the ecosystem. So it's absolutely going to work, because this is actually getting a lot of traction and a lot of support, even within the US and within Russia, within Africa, all sort of support coming from everywhere. So absolutely, I believe this is going to be a serious tactic and it's going to work.
And what do you think it's going to do for the cryptocurrency industry? And do you think this cryptocurrency industry can absorb the whole world? The world says, you know what, we want to adopt maybe Bitcoin or one of these cryptocurrencies for day-to-day trades. Is it going to work?
Yes, absolutely. I believe it is going to work. Because if this were supposed to be a question, let's say about 5, 6, 7 years ago, we might be having some doubt because of the latency in the system, because of the transaction throughput and all sorts. But now, with the ongoing development in the blockchain industry, there has been some major development that can, in a way, attract a lot of transaction throughputs. Talking about transaction per seconds, which is also in a way competing with the banking industry these days. So if a whole nation, probably a whole country, or probably even global adoption is on the verge for crypto industry, this is something that can be accommodated within the crypto ecosystem. We're having a lot of layer 2 scaling solutions, a lot of solutions out there currently, Chain Fusion along with some other major solutions, enabling people to be able to transact at lightning speed, at internet speed on using cryptocurrency. So this is actually something I believe is going to work and shouldn't be an issue at all.
But I've noticed, with most of the token generation events, if you're looking at the Ton blockchain, most of these tap to earn games, once it's time to distribute these tokens, then you start hearing talks about the Ton blockchain is now moving slow because there's too many people, trying to, get most of these coins or withdraw coins or send coins over the network. So it seems most of these blockchains are not even ready for their own activities at this point.
Yeah, well, we can say some of the blockchains are not ready, but also some actually kind of ready. They've been able to go through a lot of stress test analysis and all sorts, and the transaction throughput is actually being increased. So we have some of these major blockchains that are quite ready to be able to accommodate majority of all this. Multi-chain architectures are out there, AI integrations are out there. Every single thing that needs to be done is actually being done. Like I said, if this was to be a conversation of about several years back, I would be in doubt. But from what I've seen in the industry in the last couple of months to 1 year ago, I believe we are quite ready.
Do you think there's that one blockchain that can handle the whole world?
Absolutely, there is one. And there is only one I can think of. Talk about Internet Computer Protocol that allows major blockchains to be able to come together to interact. And of course, increasing the need to integrate a lot of features like AI and even a lot of transactions per second to take place on the chain at internet speed. So, we need to go no further.
All right, definitely. We'll keep watching out for that future, at some point, if it actually happens, and see if most of these blockchains can actually take, the pressure at this point without the middleman. But thank you so much, Adebayo, co-founder, ICP.hub, Sahara.
Thank you very much once again, Laddie.
And that's the show today. That's how most of the markets we track are looking. Remember, you can watch this again on our YouTube channel. Just flip over to YouTube and search for Channels Television. You can also visit our website, www.channelstv.com, for more updates. I'm Laddie Williams from me and the team right here at Channels HQ. It's bye for now.